When you see OpenAI valued at $852 billion, who decided? Not the stock market. In March of 2026, OpenAI announced $122 billion in committed capital at an $852 billion post-money valuation. Post-money means value after counting new capital. The announcement does not identify the investment type, per share price, share count, or attached rights. It does not say whether cash funded the company or paid existing sellers. In general, one private negotiation can set a whole company reference while shares beneath it carry different economic deals. Different shares can change what each holder receives in a sale. Later public buyers may be asked to price a different kind of share. This is a generic possibility, not a claim about OpenAI's undisclosed terms. One private negotiation created the reference price. Which slice did it price, and which prices did it leave unsettled? 4 questions reveal what the headline reports and what remains unknown. A private financing valuation rests on a real negotiation. The terms record how much capital investors agree to provide. The result is useful. A private company needs a way to price ownership. It may issue new shares to raise money. Employees may receive shares as compensation. Existing investors need a common language for describing their stakes. A funding round gives them a reference point. Exchange trades update a public company's share price throughout the day. A private company has no comparable stream of prices. Its reference points arrive in negotiated transactions, so the latest one can carry unusual weight. That reference can coordinate a lot of decisions. It can describe the scale of a round and supply an input for ownership calculations. It also records how the latest investors priced their entry. OpenAI's announcements show that reference moving. In October of 2024, the company announced $6.6 billion at a $157 billion post-money valuation. In March of 2025, it announced $40 billion at a $300 billion post-money valuation. By March of 2026, the announced post-money figure was $852 billion. Each round supplied a signal at a new moment. The latest one did not erase the earlier signal. It recorded what a new set of parties agreed. The $852 billion figure deserves that fair hearing. The harder question is how far one transaction's reference price can travel. Think of OpenAI's announcement as a receipt with the total showing and the line items removed. Each absent input answers a different economic question. The kind of investment tells us which contractual package was priced. Finance calls that package a security, a share or another investment with defined terms. Without that line item, we cannot tell which package supplied the reference. The price per share and the fully diluted share count explain the multiplication. Fully diluted means counting existing shares plus other claims that could become shares under the company's rules. Without those two inputs, a reader cannot reconstruct the headline or see which potential shares entered the count. Rights answer a different question. They can change voting power or the order in which holders receive money in a sale. The transaction split changes the story again. New shares can direct cash to the company, while existing shares can direct cash to a seller. Those distinctions can coexist under the same whole company headline. That is why the missing line items matter. They determine what the observed price can safely be compared with. The omissions do not suggest that OpenAI did anything improper. A public announcement is simply not a full transaction record. We know the committed capital and the valuation. We do not know whether OpenAI's other shares carry the same economics as whatever the round priced. That missing receipt points to the mechanism behind a conventional private valuation. A venture law guide from Cooley gives a conventional worked example with no outstanding securities waiting to convert into shares. The parties negotiate a value for the company before the new money arrives. They divide that pre-money value by the fully diluted share count. The result sets the per share price of the newly issued security. Add the new capital and you get the post-money valuation. The multiplication turns a slice-level price into a company-level reference. One part of the company changes hands at a negotiated price. Then that price becomes the reference for a value spread across the whole share count. The round therefore does two jobs at once. It moves capital between specific parties and it creates a reference price for ownership beyond the shares in that transaction. The second job is what produces the number in the headline. Call this the priced slice. Imagine an airline sells one first-class seat. Now imagine using that ticket price as the reference price for every seat on the plane. Multiplication can produce a clean total. But the multiplication does not prove that every passenger bought the same ticket. The comparison is intentionally imperfect. A financing does not simply multiply one literal ticket by a cabin count. It uses a negotiated per-share price and a fully diluted share count. The plane makes one point visible. A price observed on one slice can extend far beyond the slice that was actually priced. The airline is only an analogy. It explains a conventional financing mechanism. OpenAI has not publicly disclosed the security, price per share, share count, or rights from its March transaction. The priced slice answers who created the $852 billion number. The parties to a private transaction supplied a negotiated price, and the share count arithmetic produced the headline. But that answer opens the next question within seconds. If one security supplied the reference price, do all the other shares come with the same deal? In a generic venture financing, the answer can be no. Corporate law allows a company to create different classes or series of stock. Those classes can carry different voting power or limits on selling. Some can convert into another class. Some can stand ahead of others when money is distributed. One common distinction is liquidation preference. That right can put a preferred holder ahead of common shareholders. The order applies when a company is sold or shut down and its assets are distributed. Some preferred stock can also share in proceeds after receiving that preference. The exact result depends on the actual documents. Back on the plane, first class and economy both get you to the same destination, but the tickets do not carry the same benefits. Paying the first class price tells you something real about demand for that seat. It does not turn every economy ticket into first class. The same caution applies to a private company share price. A price paid for one security can be a useful signal. It is not automatically the cash outcome of a different security in every possible exit. This explanation is generic. OpenAI's public announcement does not say that investors bought preferred stock. It does not disclose a liquidation preference or any other special right. That boundary still lets us name the terms that would matter. It does not let us fill in OpenAI's terms when the company did not publish them. Security rights tell us who might receive what later. They still do not tell us who received the money when the transaction happened. The next question changes only one variable. Where did the cash go? In a primary financing, the company issues new shares and receives the proceeds. The money can fund hiring, infrastructure, research, or anything else the company says it will build. OpenAI said its announced capital would support infrastructure, research, products, and global deployment. A secondary sale works differently. An existing shareholder sells shares to another buyer. The seller receives the money. The company may receive none of it, even if the transaction supplies a fresh price for its shares. Facebook's 2012 public offering makes the distinction unusually clear. Facebook sold 180 million new shares. Selling stockholders offered more than 241 million existing shares. Both were priced at $38, but Facebook said it would receive none of the proceeds from the seller's shares. Same offering price, different destination. Private companies can also pair a primary financing with a company-sponsored secondary sale. But OpenAI's March announcement does not tell us whether its transaction included any secondary component. The public answer is simply unknown. One negotiated transaction can set a price without settling every other price. The next test arrives when a new financing, or a much larger group of buyers, gets a vote. A later financing can negotiate a different per-share price. If that price is lower than the earlier round, it is called a down round. Existing preferred stock may carry anti-dilution protections, rules that can adjust how the lower price affects those holders. Again, the rights depend on the documents. An initial public offering, or IPO, opens shares to public investors for the first time. The company and the banks running the offering study the business and market conditions. They collect investor indications in an order book, a record of demand at possible prices. Then they negotiate an offering price. After the shares list, public trading keeps producing quoted prices. More buyers and sellers can respond to new information every day. The sequence changes who participates. A private round reflects the parties admitted to that negotiation. An IPO invites indications from a broader investor group. Public trading lets the buyer pool keep changing after the offering. Each stage adds observations that the earlier stage did not have. A public quote still leaves the company's underlying worth unresolved, but it changes the evidence. A private round gives us one negotiated transaction. An IPO adds an order book. Public trading adds continuous quotations. The plain analogy changes here. The gate opens to a much larger crowd, and the next ticket price can move. A later buyer does not have to accept the price from the last private round. That is why one company can carry several meaningful prices at once. A financing price, a secondary sale price, an IPO price, and a later trading price answer different questions at different moments. The labels in future headlines now become clues. A down round compares one financing price with an earlier, higher price. A secondary describes an existing holder selling. An IPO describes the first public offering. None of those labels is a complete verdict on the company. Each identifies the kind of transaction supplying the new signal. Once those prices separate, the original headline becomes easier to read. OpenAI's $852 billion price tag now reads differently. It records one specific kind of useful information. Question 1. What security was priced? A common share, preferred stock, or something else? For OpenAI, the public announcement does not say. Question 2. What rights came with it? Voting power, conversion terms, and payment order can change the economics. For OpenAI, those rights remain undisclosed. Question 3. Where did the cash go? New shares can fund the company. Existing shares can pay a seller. OpenAI states how it plans to use the announced capital, but the public text does not give a primary versus secondary split. Question 4. What share count turned the price into the headline? In a conventional priced round, the fully diluted count supplies the number used in that division. OpenAI did not publish the count or the per share price in this announcement. These questions make a useful valuation readable. 4 questions are enough to tell which price a private valuation reports and which price it does not. The next private AI price tag can now be traced back to the transaction that produced it. A private valuation is one transaction multiplied across a company, not a receipt for the company. If you want the next giant AI number decoded before the headline hardens into common sense, subscribe.